Good day all. Procter & Gamble, a famous company known for their cosmetic and hygiene products, are looking into launching Crest Whitestrips Advanced Seal in the United States of America. Our team, consisting of Caleb Moonsamy, Lindokuhle Bhengu, and myself, Yuvani Pillay, were tasked with the financial analysis of the product. First, we looked into determining the base NPV as well as the weighted average cost of capital. We used the capital asset pricing model to determine the cost of equity, which was 0.14%. We then looked at the cost of debt, which was 0.97%. Lastly, we looked at the cost of preferences, which came to 3%. The total market value of the firm was approximately $255 billion. After multiplying the market value with the appropriate costs, we came to a weighted average cost of capital of 11.15%. Throughout the analysis, we stuck to a few basic assumptions: a lifespan of 4 years per project, a discount rate of 11.15%, an exchange rate of 14 Rand and 86 cents to the dollar, and a tax rate of 40%. For the base case, we used a selling price of $22 per unit, fixed advertising of $6 million, zero depreciation, an initial investment of $2 million, labor costs of $1.2 million, net working capital of $440,000, which was recovered at the end of year 4, and erosion costs for both the basic and premium Crest products, which after tax came to $1.02 million. The base NPV calculated was approximately $19.471 million, which multiplied by the exchange rate gave us 289.34 million rands. This shows that the product is suitable to launch. After calculating the base NPV, we then determine the accounting and present value break-even points to identify when profits can be recognized for P&G. With the accounting break-even, P&G would need to sell more than 750,000 units before recognizing any profits. With present value, P&G would need to sell more than 954,000 units before recognizing any profits. My colleague Caleb will now discuss the 3 scenarios.
Let's take a look at our scenario analysis to know all of our possible options. Firstly, in scenario 1, there are 2 major changes. Advertising has increased to $10 million, but has reduced thereafter to $6 million. Production has increased to 2,150,000 units in year 1, but has remained at 2,050,000 units from year 2 to 4. This yielded an MPV of approximately 280 million Rand, which is a reduction of approximately 3% from the base case MPV. This would mean that we would have to reject this scenario, and it also means that we cannot spare time for increased advertising. In scenario 2, we invest $1.5 million in new machinery. This investment caused many variables such as selling price per unit, sale units, as well as cost of goods sold per unit to increase. The MPV of option 1 is 367 million Rand, and it is much greater than the MPV of option 2 of 356 million Rand. Option 1 is the greater choice to accept. However, it doesn't account for increased cannibalization in premium and basic product. Therefore, we need to include these changes in order to reach an accurate MPV. In scenario 3, we account for increased cannibalization in premium and basic product. Since scenario 2's option 1 yielded the higher MPV, we will use its assumptions on variables as well as include increased premium cannibalization to reach a new base case MPV of approximately 292 million rand. This will be our new reference point. We are now left with two options. Option 1 basically replaces the existing line of products with the new product, which is advanced seal. Advertising expense increases by $2 million only in year 1. Additionally, sale units as well as premium and basic product cannibalization increases from year 1 to year 4. Whereas option 2 changes the positioning of advanced seal to make it seem more unique. There is no additional cannibalization in premium and basic products. However, there is a decrease in units of production of 100,000, and there is a decrease in advertising of $5 million from year 1 to year 4. This led to an MPV of option 1 being 309 million rand. This MPV is much greater than the MPV of option 2 of 295 million rand. Therefore, we would choose option 1. And the strategy in this option is to replace the existing line of products with the new product. This means that we would have to eat our own lunch in order to get a greater return on investment. I will now pass it to my colleague, Lindokuhle, who will discuss project evaluation as well as risk. Thank you.
With the operation in approximately 700 countries and a good distribution in more than 180 countries and a territory worldwide, we are a multi-organization. Distribution in our global supply chain will have a negative effect on company performance. The risk, the economic risk in the United States, such as current fluctuation and the inflation, may decrease the company future cash flow and market value. The oral care segment seems to have a fluctuation in the growth rate, and with the United dollar being much stronger than rand, this seems to be concern regarding the launch. Okay. Crest Whitestrips have a negative growth, and other toothpastes has a positive growth. Growth in the markets, but you need to be aware of a fluctuation. Okay, the important question: does this pay out to our business? Option 1 has a higher NP value of 309 million compared to the option 2 of 295 million. So we have to mitigate the option 1, maximizing the return on the investment and increases the shareholder return. Keep in mind, before we design it, we need to address the existing consumer issues with the current product. Implementing a new treatment can affect the profit on the investment and the return on the investment. Packaging of a new product. Areas for P&G to focus is on accelerating the growth of a product in the United States. Accelerate the growth through marketing, feedback through online surveying. Conclusion: the NPV for option 1 was greater than the other options. This option utilizes the strategy to position advanced sealing as more of the replacement products for the existing line. Therefore, Crest Whitestrips advanced sealing is launched in the United States. P&G should implementing the option 1 strategy. Thank you.